Hi everyone. We'll just give everyone a few seconds to make their way into the webinar. I usually give 30 seconds to a minute, and then we'll get started. So just bear with us. Yeah, there's still a few people making their way in, so we'll just give it another 20 seconds or so, and then we'll get started. Great. I think we can get going. Welcome everyone, and thanks for joining us. This is our first investment update for 2026, and what a first quarter. It's been a bit of a roller coaster first quarter. So thank you for joining us. I'm James Fouché, Senior Investment Account Manager here at P1, and as always with me I have our Chief Investment Officer, Will Dixon, and Will be taking us through the majority of the content today. If you haven't joined us before, we do ideally try to keep these sessions as interactive as possible. So please, if you have any questions, there's a Q&A area that I'll be monitoring, and feel free to stop us if you have a question, and we'll try to keep it as interactive as possible. And then CBD points, we will be sending those certificates out to you for attending in the coming days. In terms of an agenda, to what we think are two of the more important topics, current topics at this point in time: the Iran conflict and AI, and how that's impacting our thinking in general and around portfolios. So we'll be sharing his thoughts on those. We'll then go through some P1 portfolio updates, and then I'll take us home with some P1 service updates as well. We are trying to get the timing of these right, so we might finish a little bit earlier than normal, depending on questions. So hopefully we can give you back some extra time today. But that's it from me. Will, over to you.
Thanks, James. Thanks everyone for your time today. I think we did want to focus on the longer term view, and AI is obviously that element there, but it also felt a bit remiss if we didn't cover the top topic in markets and investors' minds at the moment, which is Iran. So we're going to try and keep that part brief. Just acknowledge that that's going on, but I think that the important topic that we wanted to cover today was really a thought experiment on AI and how we're beginning to think about that and how it might affect portfolios in different asset classes. So quickly on Iran, this you may have seen this image already up in the top right of the screen, but I think we've got to acknowledge that we're not in a position really to try and judge actually what the outcome is going to be when that is going to happen, because quite frankly I don't think the participants know that either. But in terms of where the current situation is, I mean, clearly oil has become a lot more expensive, and it is being incredibly volatile day to day, just based on Truth Social updates and rumor. Clearly the longer this situation goes on, whoever's blockading the flow of energy out of the Strait of Hormuz, we will just gradually get an increased pressure on the oil price and other products coming out of the Middle East. The price will just gradually grind higher. Those spikes will get higher, the lows will get higher over time. I think we are perhaps slightly more fortunate in the UK, Europe, and more so in the US, where actually it is only the price that's been affecting things so far. Here, if you go over to Asia or places like Australia, there's a real concern that you're already getting actual shortages. So almost with regardless of the price, there is nothing available. So potentially we're beginning to get to the point where there is real demand destruction going on. Activity is not happening because you cannot get hold of the things that you need. In terms of the market reaction already, bond yields have gone up. They have settled down slightly, which is good, but clearly there is a concern regarding inflation and fiscal sustainability. We'll come on to that a bit more in a moment. Interest rate expectations again have risen purely on the back of a repeat of 2022, where inflation concerns based off energy going up and the knock-on effects of that. Inflation rate cuts have been priced out, and potentially some rate increases are on the table again. Equities lower, and I've had to add to this brackets initially, subsequently having written this, because we've had quite a significant rally over the last week or so, really taking us all the way back to the end of February before this crisis began, and further, particularly when you look at US equities. So that's not particularly true anymore, but clearly if we got an escalation, equities going low will be a natural response. US dollar stronger, there's that flight to safety element there going on again. That's slightly reversed already, and then perhaps probably the one that may stick for longer is that growth expectations have been impacted. So going back to my point on lack of supply and activity not happening, clearly that has an impact on GDP growth. Also, you will find that, with fuel prices higher, with energy prices higher, people will be much more careful about how they use energy, and ultimately, therefore, GDP will be impacted. So those expectations are being revised lower already. So the way that we thought about it, this situation from day one is the two scenarios that are in front of us, which is that this is a continuing crisis. It escalates as scenario one, where energy prices they continue to go higher, that you get these aggressive spikes, and it stays there for a sufficient length of time that it goes through the system and impacts real decisions. Obviously, if you have an oil price spike for 2 days and it comes back again, it's probably not going to have an impact. People don't change behavior. But if it stays there for several months, people start making replacements of things that are now more expensive. And inflation pressure builds. So obviously the natural one that we've already seen, we've had UK inflation come out already. US inflation is already reflecting petrol prices, diesel prices going higher. We'll obviously get energy bills going up in the next 3 to 6 months. But then there are knock-on effects to things like food, so fertilizer prices going up. Obviously, a lot of diesel is used in agriculture, logistics, so shipping costs, lorry costs, etc. That happens sort of 6 to 12 months after the initial price spike in energy. So we have this rolling issue where inflation won't necessarily fall back, even if the energy price falls back. Perhaps in 3 to 6 months' time, there'll be a sort of legacy inflation that needs to work its way through the system. And ultimately, if this goes on for long enough, you get a repeat of that 2022 situation where ultimately workers are going, inflation is now so elevated, I want to be rewarded more through my salary, and then that impacts service costs as well, and which will last several years. We're still working through the impact of 2022 today in terms of that effect. Clearly, growth prospects would weaken, and it's probably likely you get a recession if this was to persist. Fiscal pressures would build. Governments would collect fewer taxes. They would probably need to spend more to provide support to those that are suffering from higher energy prices, and that would compound the concerns in the bond market. We would expect ultimately equities would fall if this continues. Clearly, in a recession, and in one where interest rates might have to be higher to counter inflation, that's not a good backdrop for equities. And quite clearly, I think it's reasonable to assume that EM would be worst hit in that scenario, because they are the ones that are ultimately lacking the real supply that would otherwise be coming to them. And credit spreads within fixed income haven't reacted hugely so far, and we would expect credit spreads to be wider as a result in a sort of an escalating scenario. So how would one position for this if that's what you thought was going to happen? Ultimately, being short duration or cash within fixed income to protect against that increase in interest rates. Underweight equities, obviously, to counter the likely fall in equities, and then have it gives you both of those give you the optionality to perhaps add risk if there are sort of liquidity events where the market sells aggressively. The second scenario is perhaps the one that is now being priced in almost fully into markets, which is that there is a piece of some kind agreed, and we don't need to get into precisely what that looks like, but at least a piece that results in oil and other products flowing fairly freely through the Strait of Hormuz. So perhaps oil would fall back to something like $80, not all the way back to 60 that it was trading at prior to this. Some capacity has been taken out, and clearly inventory is going to need to be rebuilt in almost every country, which has been drawn down. And there would probably almost be an incentive to increase that inventory as well throughout the whole system to avoid or protect against this crisis again. People will want to, or they'll be willing to pay a premium or hold capacity to protect against that scenario. Bond yields would likely fall back somewhat. EM equities would probably be most in favour as peace came about, because those have been hardest hit. Dollar would likely weaken, ultimately reversing all of these trends that we've seen. However, I think we've probably already reached the point where some economic damage has probably already been caused, and all else being equal, you would therefore expect that you're probably likely to see rates expectations fall below where they were prior to this crisis, because central banks are more likely to have to step in and support the economy with lower rates. Probably not equally across the world, but certainly certain places will feel the need to do that. And as I put here, has this already happened? We've seen an equity market rally. We have seen bond yields come back somewhat. The dollar has weakened from its highs. So, as I said, I think this is likely what is being priced in, maybe 75% or so into the market already. So the positioning to benefit, maybe there's still some left on the table, but perhaps this has already been reflected already. But clearly, EM has been the main beneficiary of the rally. Fixed income duration has benefited from those falls in yields. And credit, hasn't been the opportunity, or hasn't really presented an opportunity through this crisis. So that continues to be where the sort of two outcomes we want to think about. We're probably it does change day to day, but I would say we're much closer to this second scenario being the market sort of view at this point. So hopefully that was. Are there any questions, James?
Yeah, sorry. Well, no questions, but just I do know there's a few new users of our portfolios on the call, and I just thought, I mean, if you go back one slide again, that positioning to benefit just stands out, because I mean, you and I spoke, I think it was two or 3 weeks ago, about, I guess, the predictability of market prices, and I mean, if you were told the week leading up to when the war really kicked off, there's a war coming, you probably would have loaded up on something like gold, and gold since the war hasn't exactly been a defensive asset class, although maybe over the last year or certainly over the full quarter it's done the job, but it's experienced some tough price moves. And I just thought, if you could give us some insights into how tactical we are in, for example, our low cost asset tracker range. Although it's low cost, there is some tactical asset allocation that plays out there. And I know we came into 2026, for example, quite negative on US equities. there's obviously been volatility in the quarter. Is that something that we've taken advantage of, and at what level? I guess, if you're in an adventurous risk level, you're not going to go from 100% in equities down to zero. So if you could just give a bit of insight into how tactical we are.
Yeah, so absolutely, these aren't, we're not trying to express whipsaw between these views in any way. What we're really trying to find is balanced ways of getting asymmetric type risk reward scenarios. So what I would say about this whole crisis is I don't think there's been a day where you could say there's a clear opportunity in either direction. So at the time of our quarterly ICM and rebalance, the market had mostly recovered what it had lost. We were, modestly defensively positioned going into this. And it just didn't feel like there was really any opportunity to make any dramatic change from a sort of overall risk perspective. So yeah, these positionings to benefit are more just helping us form that view about where those opportunities might occur. But I think, as an example on this one, you would want to see probably 15 to 20% have come off EM equities to really go, actually, as a long-term investor, I'm happy to perhaps look through this shorter term issue. And think that it will be resolved, in a reasonable time frame with not a sort of critical level of damage, and get that exposure. Whereas that in reality, it was sort of 8 to 10%, and probably was a fair reflection of the changing situation. So in terms of, we haven't, I don't think, been presented the opportunity to make wholesale top-down changes so far. Other than small tweaks. Obviously we'll come on to the slight changes we have made, but yeah.
Okay, cool.
I think as I said, we've got to be modest in what our ability is to time and get the direction and the asset class choice correct, particularly in an environment where we can make a decision and a tweak and come out 2 days later, and it's it can throw you right off.
Yeah. Well, price moves were really volatile, and I mean, just back to that gold point, we've been quite happy with our gold allocation over the medium term, really. So I guess we're content how the portfolios came into 2026, and almost content at how they managed through the volatility in the quarter, I'd say. But you'll probably get onto that.
Yeah, we will. And on the gold point, yes, it I guess did suffer in March in that selling, but it did do so well in January, February. When we look over the quarter, it was still an outperformer, within the portfolio. So it just shows you how short-term markets are in terms of viewing these situations, but also, how strong that asset class has been, obviously last year as well. So,
cool.
But onto AI, which was really where we wanted to focus on, because it is a longer-term theme, and we think it will drive, potentially more structural changes within how we position portfolios as well. So this is really a thought experiment. I think we probably caveat this that we're trying to work out something that really no one knows where this is going to end, or where we're going to be in 3 to 5 years in terms of this technology. It will obviously create things that haven't even been thought about yet, in terms of disruption and new products and services, etc. But really to think through, I think, a scenario. I think we probably part of this is trying to push back at the concept that we all can see AI and how great it is at doing certain things, and people naturally want to say, how can I profit from that from an investment perspective? I'll buy an AI tracker, or an AI themed fund or something. That's a natural reaction. They're going to make loads of money. They're going to be really disruptive. And I think this is partially a challenge to that thought process, because I think there is a risk to it. And then, what are the potential opportunities, and particularly the protection against the disruption that technology can cause. But just to talk through these points, clearly AI reduces the cost of production in a lot of areas. We can already see that. I mean, I've put images here because I created a lot of the images for this slideshow using AI. So it was a clear one for me. You used to have to pay for images to use, and now we can just type prompts in and generate them. You can write entire books and get them printed for very little. Things like translation, which used to be very expensive, now can be done very well with artificial intelligence. There are many other examples, but the point is it's a bit like perhaps communications back in the day. You used to have to send a letter, then we had email, and it's essentially costless, and we send thousands a day. So the sectors at risk are clearly things like software services, knowledge. We can all access all knowledge now, essentially, and a lot of the tech sector is most at risk to this disruption. Obviously, initially, new AI tools will disrupt all those incumbent companies within the sectors. And so there might be a window where they make good returns as they're replacing something that used to be expensive with something that costs very little to produce. But actually, over the very short term, and probably quarters, and if not just a very short number of years, these disruptors will then get disrupted themselves, or they'll have to compete with other AI operators as they see them making these very strong returns, having disrupted the incumbents. And essentially, it's capitalism. The price will go down as they compete, and their margins will compress. That is ultimately what will happen in a free and fair market. There are low barriers to entry. We've already seen that AI companies either doing these large language models or off the back of these doing more specific tasks, they've come from nowhere in a number of very short years, from having no value to having these extreme valuations. I'd expect that to continue to happen because there is very little barrier to entry. They don't have to build lots of factories. They don't have to employ lots of staff. Obviously, the infrastructure is being built out at the moment, but that's a slightly separate point. In terms of the front end disruptor, there is very little barrier to entry. So as an investor in a potential AI disruptor, what profit are you then being rewarded down the line? You've disrupted an industry, but then you're having to compete aggressively with other AI companies. So that I would argue that in the end, actually, your profit to be returned is potentially not as attractive as people may think it will be. And ultimately, some AI investments will clearly be redundant. That money will have chased things that ultimately go nowhere. Probably the easiest way to put it is there'll be a big overcapacity in certain areas of the AI market. What does that all mean? It's capital destruction. So that's either capital destruction because AI investments have become redundant, or actually it's these incumbent companies that currently have tens of billions of dollars of market cap value actually essentially get worth nothing, because their whole business has been destroyed, or they've had to become an AI company themselves. And the value that's created by those disruptive AI companies is not sufficient to replace it, because their margins are low and they're having to be competitive with others. The good news is that, sorry, go on, James.
Yeah, sorry. Well, just on that, almost the valuations discussion of specifically the big tech companies. It's obviously one of the bigger discussions of the day and the bigger topics, and a metric to measure valuations is PE, and I guess prices have been high, arguably, but the earnings side of things, which you've touched on there. Correct me if I'm wrong. Has there been an earnings update looking at 2026 where certain analysts are actually predicting earnings to surprise on the upside, and so the PE aspect has come down, and so valuations arguably have come down regarding specifically the tech side of things?
Yeah, definitely, and I think this may I think here we're trying to look maybe 3 to 5+ years out, and there's definitely this point in the short term, and they're making lots of money on the infrastructure build outs. Someone like Nvidia is they can't sell enough of the chips. There's a lot of perhaps circular investment that is creating revenue and profits as this infrastructure, they're competing against each other, they're trying to build it out, and in the short term that may well generate lots of earnings. So yes, from a headline perspective, and part of the reason we've had this rally, valuations and earnings have been more attractive than they have been for a while. So I think here I probably want to separate the short term. People will disrupt incumbents. They will have perhaps increased demand for certain things, and that will create an opportunity in the short term. But actually, in 5 years' time, we look back, will those investments in, say, data centers for $1 trillion or whatever the number will be, will that get the return that it should have done given the amount that's spent? My suspicion is probably not. That's not to say they shouldn't do it, because it's sort of existential for them, but
Okay.
The good news is that at an economy level, if the cost of production is falling and we can essentially produce the same thing for less money, that's incredibly good for productivity, for growth, and for prices. So the overall level of inflation to buy the same basket of goods and services should fall. And simply put, as I've put here, the consumers of AI will win, and that's not necessarily the consumer, individual, you or I. It might be the companies that are consuming them, these tools and services that they otherwise would be paying for. But what does that disruption mean? It might result in large parts of the workforce not being needed anymore, so skills being made redundant, and governments are probably going to need to be stepping into these areas to provide support, welfare, retraining, and that's likely going to mean more deficit spending, similar to what we've experienced for sort of a decade or so already. And to help that, you might find that central banks will be willing to lower rates, because we'll have a situation where inflation might be falling, negative, arguably in some areas, and demand might be reduced because you do have rising unemployment. So they may be comfortable going, actually, we do need to return to very low rates, or we do need to restart QE. In which case, that newly created money, or those low rates, are going to have to find something to do. And we've experienced this before, where actually, in a lot of cases, if QE is used, it gets sucked into assets that across all areas. So things like property as well. So asset prices may go up if that scenario plays out, and become inflated, as I put there. So really, the end of this sort of thought experiment is what assets would benefit in that scenario. We sort of touched on the fact it's less likely to be at a sort of basket level AI as a whole, as a theme. Obviously, there may well be winners within that, but we would argue it's much more likely to be real assets. So. And we've got a few examples here, and I'm quite willing to receive any other ideas, because that hopefully there are more that we can use. But this is the first run through, really. But things like infrastructure, they're difficult to disrupt with AI. They're unique. They're often regulated. They have long-term contracts that may well even be government backed. Things like property, which you can't just build as much as there is demand, because there are physical constraints, particularly when you think about a city, things like regulatory planning barriers, etc. And also, humans are physical. We do need somewhere to live. We do need somewhere to go out, eat at restaurants, etc. So they are required. They can't be disrupted away. Gold, it's an asset we continue to like, even though it's done very well. It does have a historical store of value, particularly if if central banks are likely to return to QE, gold we would expect would be a sort of main recipient of additionally created money. And perhaps the new one, the one we're gaining confidence on is this commodities and miners. These are cyclically sensitive. So there's a sort of risk on type bucket. But actually, if we go back to our scenario where service prices fall, perhaps there's more available money to go after goods. How are these goods being made? They do need iron ore, they do need copper, they do need other raw materials, and those do have to be dug out of the ground in the real world. So actually, owners of these mines, they may well get more efficient, but they're likely to do well. And then finally, perhaps the most controversial one is regulated industries. So I've put financial services on there, which may be received well with the audience here, but whenever there's a sort of regulatory hurdle to overcome, it will certainly slow down the level of disruption, because there are more things that have to be done, be complied with to get regulated. It will take a certain length of time. It all just slows down the level of the pace of disruption. Pharmaceuticals on there, you have to go through trials. You have to get something approved. It doesn't happen as quickly as it may in other areas. So again, could be an area to protect value. So from an investment perspective, actually just buying a simple fixed income equity market cap weighted portfolio, that there potentially is risk in that scenario. You're getting this value destruction potentially within equities. You're getting loose monetary and fiscal policy, which would be damaging for just nominal bonds. And then you might get these repeated supply shocks within commodities and energy, as the economy changes and demand for different things sort of changes more rapidly. So you will get, as we've experienced over the last 6 to 7 weeks, the positive correlation between fixed income and equity may turn positive again. However, we could well be wrong. So I think we've got to acknowledge that. I think we've got a good thought out sort of thesis there, but we also do have to acknowledge that may well be wrong, and something different may occur. So technology companies may well become monopolistic, whether through some form of regulation or through the control of a certain element of the value chain, and they are able to retain a sort of exceptional margin and therefore sort of equity value. Central banks may feel that actually they don't need to cut rates and use QE, because actually this is a technological deflation, and actually they don't need to stimulate the economy. And in that scenario, actually something like cash would potentially be more beneficial, because it actually increases in value in a deflationary environment. I think this one I think is the biggest challenge for me, is that actually there will be new markets that get opened up that don't exist today, and that will create new companies and new opportunities to invest, and create new value. And hopefully the last point there on employing workers, I think, is an important one as well. Is what are the people that are getting disrupted going to ultimately be doing? And we have had technological innovation where there's been that concern before, and ultimately people are still employed today, doing different things that never existed historically. But I think the sort of challenge to the challenge there is, will the largest companies today be the winners and the largest companies of the future? Again, we could well be wrong, but I think history has got a long record of suggesting that's not going to be the case. I suspect that the largest company in 25 years' time is unlikely to be in the list of the 10 largest companies today. So again, buying a market cap weighted index as your only holding does contain risks to it, and from that perspective. So again, I'll just pause there briefly before we go on to the portfolio update.
Yeah, there is a question, Will, on fixed income and really the defensiveness of portfolios, but I'm tempted to wait until the portfolios update, and then I'll ask that once we're done with that.
Cool. So over the quarter, again, we just put the asset tracker moderate and wealth accumulator moderate as the sort of two central risk core portfolios on here for comparison. It's been a reasonable quarter from us from a relative perspective. Obviously, in absolute terms, you can see, it's been a quarter of two halves in that it was quite a nice backdrop for 2 months, and then we've had the onset of the Iran war and clearly a drawdown event. Both portfolio ranges have outperformed. The asset trackers have done slightly better. Part of that is down to the use of miners in the gold allocation within the wealth accumulators have seen a greater drawdown as liquidity has been removed, but also a greater small cap bias in the wealth accumulators, which has been an area naturally that has been impacted, particularly in the UK. Over the 1 year, we've got a very strong relative performance on both portfolios against the benchmark here. Again, that's being driven by the same factors, which we'll go on to in a moment, but things like gold, things like infrastructure more recently have been big drivers of that relative performance. So I think it's important to highlight it is actually already these differentiated areas, moving away from perhaps a traditional fixed income equity benchmark that have been positive drivers of that performance, as you'd expect. So over the quarter, we touched on gold already, but I'll just reiterate that it was so strong. So it's difficult to recall actually that you had this almost parabolic rally in the gold price towards the beginning of the year. That actually, although the drawdown felt quite aggressive in March, the rally beforehand was so strong that it was still up over the quarter. And we feel we generate a really strong benefit from being able to rebalance in and out of this as an asset over time. And actually that we find that actually the volatility is to our benefit through doing that. Probably the biggest contributor though is infrastructure. And this has been for those that have joined us on perhaps the last 2 or 3 quarterly webinars is been our point of greatest conviction, and an area that we've been adding to. So this has done something like 10+% over the quarter, and that's in an environment where portfolios as a whole have been broadly flat. So it's been a big area of added value, and it's nice to see that it's been defensive during that March period as well. It hasn't necessarily risen, but it hasn't drawn down in the same way as other assets have. And you can sort of understand that they're not movable assets. They tend to be in developed markets away from the area of conflict. So they should be protective given the backdrop. Emerging markets and Asian equities, again, similar to the gold, they have been affected over the last month or so, but they were particularly strong in January, February, again, backing up a strong end to last year. And particularly when you look at these against emerging markets, against US equities, which obviously the big component of the equity market overall, have been particularly strong. And that is an active overweight for us within portfolios. And then within portfolios where it is relevant, there have been some selective active funds that have been particularly strong. And just to highlight, this is within our retirement income portfolios. The Artemis Global Income has been a strong contributor over the last 3 months. Again, backing up actually quite a strong previous year. In terms of changes, we have added to Asia and emerging markets. Again, at the time of the change, which was at the beginning of the month, they were the most impacted area following this conflict. So we were happy to take some additional risk there, which has subsequently been proved to be at least in the short term correct. That has been taken from UK, which has been particularly strong area over a number of years, and we've had an overweight to that area. Valuations have come down modestly. They're perhaps more normalized, and we didn't feel like there was perhaps a rationale to retain an overweight. It's not that we're necessarily negative on the UK, but perhaps the reason for the overweight has been removed. We retain that overweight to infrastructure, even though it has performed well. I think I'll just refer back to those AI points that we've been making. I think there's a longer term conviction for that as an asset class over multiple years, rather than just for these shorter term periods of outperformance. And then actually overall equity positioning, we're retaining a modestly underweight position there. Again, at the time of the rebalance, it was felt that there wasn't an opportunity to add to risk overall, because that we'd already seen some of a rally, and actually the drawdown, given the backdrop, wasn't actually particularly aggressive to start with. And then just a few fund changes. The Stewart Investors Asia Pacific leaders, we're just continuing with that switch into the M&G Asian, that's in the wealth accumulator portfolios. Similarly, adding in the blue whale growth as a risk on option within the wealth accumulators as well. Again, that's been a well-timed addition given the sort of rally that we've seen already. And then what we're also trying to do, just on this final point, is enhance this exposure to infrastructure across all portfolio ranges. So these two funds have been used in the ethical and responsible asset trackers respectively. And we just want to ensure that we've got this thematic exposure represented in sort of equal ways across the different portfolio ranges, so that regardless of which one you're using, you're getting a similar view from us in terms of where it's positioned. Obviously, there are nuances to these different types of infrastructure, but perhaps that's a discussion for another day. So again, I'll pause there, James, before your few slides.
Before my bit, yeah, just a maybe a slightly long-winded question, but just coming back to something you said earlier about what if we're wrong, or we could be wrong. And I think for long-term investors, you don't really want binary outcomes playing out in portfolios, and so you do want multiple ideas playing out within portfolios. And you've touched on a lot of what I would say is the more equity-centric ideas that we make use of in terms of that toolbox. If you look at our asset trackers and our wealth accumulators, but I'll speak about the asset trackers again. It's a low-cost solution. In terms of price, it competes against, I think you mentioned the equity fixed income split ranges out there, and we've got a little bit extra playing out in there. You've touched on listed infrastructure. There's gold. So I'd say within that equity, almost that growth carve out, there's some extra diversification playing out there. There's a few more ideas playing out there, which ideally almost smooths out volatility over time. And that's what we're after. We're not after that binary outcome. We're after that smoothing out, that risk-adjusted return outcome. And I'll touch on that actually in a bit when it comes to the Defaqto research recognizing that. But just in terms of the fixed income aspect of our portfolios and our thinking around that, because I guess fixed income in a lot of model ranges, MPS ranges, fixed income is there to manage volatility as well, to almost, well, with sequence of returns outcomes in mind, specifically for retirees drawing in an income. I feel like we've got our fixed income thinking playing out on top of the diversification playing out in the equity carve out. Could you just give us some insights into how we're thinking about fixed income currently and how we positioned?
Yeah, so within the way we will typically think about fixed income, and there are obviously nuances underneath this, but you've primarily got two risks, which is duration and credit. Now, yeah, there are other forms. You can talk about inflation bonds and whatnot, but I think primarily duration and credit is the two levers that we'll look to pull within fixed income. Duration is where we expect yields to fall more than the market anticipates. We would want to be longer duration, and then credit, where you perhaps would expect either credit spreads to stay stable or fall. We would want to be adding to credit. At this point in time, we've been increasing duration gradually, perhaps a more neutral position. I think I wouldn't say we've got particular conviction in either way on that duration lever. And then on credit, I think it's difficult to argue that there's a great opportunity there, purely because credit spreads are tight, and you've got actually both of the things we've talked about today, being Iran and sort of energy prices, as well as actually longer term AI. Both of those are potentially risk factors for credit, because they will be very disruptive for certain areas of the market. So how does a fixed income allocation look for us today? It's maybe slightly short to neutral duration and then underweight credit. And then we feel like that ultimately gives the best balance of diversification to the rest of the portfolio. Credit does have a positive correlation with equity, so you don't want, if you're concerned about equities selling off, you don't just want to go loads of high yield bonds, for example. They may be slightly more defensive, but ultimately they are positively correlated. The duration will perhaps protect in a scenario where we get a recession, that perhaps energy prices do fall back, but actually there's enough damage and a recession plays out. Actually, duration will be defensive there, and I think we're keen to have different expressions of defensiveness. So things like gold, things like infrastructure, they all perform at different times, and we've had multiple different types of crises, and different assets tend to do well. It's very difficult to anticipate which ones those are going to be ahead of time. When you mentioned gold, so yeah, we don't just want a simplistic defensive assets are government bonds. Aggressive assets are equity, and leave it there. We want to have a little bit more nuance to that.
That makes sense. And obviously duration being a lever that you could pull leading up to 2022 when interest rates went up, and if you were stuck in high duration fixed income carve out, you experienced quite dramatic, almost unprecedented capital losses in 2022. I think in some portfolios, those portfolios are still recovering today. Which is interesting, but that makes sense. I mean, for
short duration was still painful. Yeah, I was going to say short duration was so aggressive, but you definitely didn't want to own 20-year government bonds then.
No. Well, it was you had if you were short duration, you probably had capital losses in a conservative portfolio of maybe 5% versus long duration of 15 to 20%, and for conservative investors, that's painful. Just interesting with that duration as a tool within fixed income carve-outs, I think is just a really interesting discussion. I'm just conscious of time. We do have a question from Di on our AIM portfolio. I'm not sure if that's one for Gordon, the portfolio manager of that solution, and maybe we can take that offline.
I think that's probably best to talk separately on that with
Perfect.
Gordon.
Dar will be in touch with an update on that. So just a couple of updates from me in general at P1. I'll just start on the left hand side. I mean, in general, we've gone through a lot of technology updates, and specifically on the platform side. Obviously, this webinar is relevant to the investment solutions that we provide, but there's the platform side of P1, and the P1 platform is regarded as one of the best value for money platforms on the market. And we've just unveiled, I guess, just reading that recent article, P1 unveils next gen platform interface to transform the advisor experience. So we've launched a new interface regarding the platform, and we're getting some great feedback regarding that. And you can expect that from us in terms of just continuing to push the envelope and drive forward and improve our tech stack in general. And that takes me on to the image on the right-hand side, in case if anyone hasn't picked up. We have launched new websites, and we've gone through a complete rebrand. Actually, you might be able to see the new P1 logo in my background, but that's in that image of the two laptops, the nice blue branding coming through for the investment services part of the business, and the red on the platform side. They now have two separate websites. So if you haven't seen those, please feel free to go have a look. And at this stage, we launched the websites earlier this month, so we're looking for feedback. So if there's any insightful feedback you're able to give us, we'd be all ears. And then in the middle there, Defaqto, just two points to mention on Defaqto. Firstly, the asset tracker as a range. I was actually in London last week at the Defaqto Awards, where the asset tracker range is rated in the top 6 ranges on market, and that's looking at over 250 plus different ranges. So definitely being recognized as really it's in the top 2% of ranges available, and that's looking at risk-adjusted performance over the last 5 years. So although we didn't take first prize, it was great to be highly commended and be in the mix there. So a good outcome there, and good recognition of the work Will and the investment team are doing with regards to that range. And then Defaqto also release every now and then articles. They do research on the market, and they provide a top 10 list at a particular point in time. And the asset tracker conservative risk level was ranked in the top 10, also out of hundreds of other equal mandates, equal risk level mandates. So some further recognition there on the asset tracker range in general, but specifically that conservative risk level. And then just the last one from my side, because of all the technology developments and all the workload that goes into that, perhaps the wider webinars that we run a time and money webinar series, and the frequency of those have maybe been a little bit less than normal, and it's because of the tech updates that we've been working on. But I usually give a bit of a market, usually a bit of a fun, active versus passive comments during these webinars. And just in the essence of time today, we're not going to be doing that. But I thought I'd point you towards, this is a screenshot from the website. You can go and you can watch a previous webinar. I did this webinar. Well, we hosted this webinar with Orbis Investments. We hosted this last month. Orbis are one of the underlying managers that feature in our active wealth accumulator range. Orbis is a contrarian asset manager, and they've performed relative to really where during the concentrated market over the last five years, Orbis have performed really well on a risk-adjusted basis, and really echoing their contrarian nature in terms of their performance. So quite interesting if you're interested in listening to some of the ideas and some of the learnings that they've gone through over the years. Considering, I mean, we had a conversation, we had a question about valuations and the Magnificent Seven, and valuations of tech stocks in general. We'll mention that earlier, with Orbis being a contrarian manager, they look at other parts of the market, and there's some interesting anecdotes in there. For example, leading up to the dot-com bubble in 1999 and the year 2000, Orbis lost almost it was more than half of their clients in the run-up to that, and then went on for the decade from 2000 to 2010, basically to outperform indices meaningfully, net of fees. So some really interesting learnings from the webinar. If you're interested to watch that on our YouTube channel, please go and have a look. I think there are some takeaways there that reflects. It's just one of the ideas that reflects in our wealth accumulator range. And I will leave it at that, except I guess just to mention, I mean, we've touched on it. We do have a full range of offerings at P1. So if you use a particular range and you're interested in another range, please get in touch. We'd be happy to support you, of course. That's it from us. Yes, Dar, we will send you the slides if anyone's interested. I will be sending a follow-up email afterwards. So if anyone needs anything, you're more than welcome to contact me. Thanks for joining, and we hope to see you on the next one. Speak soon.
Thanks, everyone. Cheers.
All the best. Thanks, Will. Bye.